Hi everyone, welcome back to the Value Investor Show. Today I want to talk through a stock that you guys love, and that's Adobe. And I think for Adobe there are two types of stories and narratives being thrown around. The first one is that it's a no-brainer stock, and the second one is that it's a value trap of the decade. Here's what you need to know for Adobe in the coming weeks, months, and year. So for today, I want to cover through 5 things. First one is the stock performance of the company versus other companies. Second one is I want to go through the financials of Adobe. Third one, I want to go through the risks. Fourth, I want to go through the growth levers. And finally, the intrinsic value of the firm. Once again, I want to thank you guys for the support. It goes beyond words. And thank you so much for being engaged, for liking, for commenting. I put so much effort and time putting these videos together, so any kind of way that you guys can support the channel, it does keep me going, it does keep me motivated, so thank you again very much. So Adobe is currently down almost 20% year to date, and for those of you that do not know what Adobe is, it's a SaaS company and owns a lot of software applications like Photoshop, like Lightroom, Premiere Pro, After Effects that are being used by a lot of designers, marketing agencies, as well as other creatives in the industry. But Adobe is not the only software as a service SaaS company that is down year to date, with Workday and Salesforce also significantly underperforming the market, which shows that this is not an Adobe problem. This is a SaaS problem. There is a narrative out there that SaaS is getting replaced and that is affecting these companies. The narrative is that AI is eating software and it could get much worse for Adobe, for Workday, for Salesforce, and other SaaS companies. But if we look at the financial picture of Adobe, for example, it does paint a different picture. Historical revenue and net income have been nothing but extraordinary. In red and orange, we see how revenue has grown year over year over year. Between 2015 and 2019, that's where we have seen a peak in year-on-year growth for revenue for Adobe, then seen another peak in 2021, and then since the launch of AI in 2021-2022, we are seeing a sharper drop, or still growth in revenue, but at a slower pace at 10 to 12%. Similarly, for net income, we are seeing much higher growth year over year, and we are seeing a picture where Adobe has very high margins. Adobe is growing in terms of net income year over year at very high levels. Adobe has a very large market share in terms of digital products, digital marketing. They're the biggest player in the market for sure, there is no doubt, and I think that is translated very well in the financials as net income is also increasing. On a return to shareholder basis, Adobe is also returning aggressively back to shareholders through buybacks. Adobe is a cash cow, they have a lot of cash and they are returning that cash to shareholders. As you guys can see, this is the total shares outstanding, and since 2006 there has been a downward trend where Adobe has been buying back their stock, especially more so since 2022 when they have started buying more than 2% of their stock, and within the last year they've bought 5% of their stock outstanding, of their shares outstanding, which shows that they have a lot of cash to invest in. They don't have anything else to invest in. They cannot acquire other companies like Figma, for example, and therefore they're buying back their stock, which is currently in their eyes probably seen as undervalued. From a free cash flow perspective, the company is growing as well. The company is now trading at a 6% free cash flow year yield, which is very attractive. It had an upward trend in free cash flow over the last 2 years, a very big upward trend, and it has a consistent growth in free cash flow, which again shows that the company financially is very sound, is very attractive. In fact, if we look at valuation, it is trading at its most attractive valuation to date, with price to sales, price to earnings, and price to free cash flow, which is what we just showed, trading at the lowest it has ever been since 2015 here that we have the 10-year chart. So the stock price itself is almost down 50%. Actually, from here it's down 50% from its all-time high, and it's trading at its most attractive valuation to date, purely in a numbers perspective. If we look at capital efficiency as well, Adobe is a capital efficiency machine. Return on equity equity, assets, investment capital is growing and is at very high levels, which is to be expected given that it's a SaaS company, is generally capital light company, but it doesn't take away the fact that it's a very capital efficient company. And the fact that it's growing, it's at very high levels, above 20% for all those metrics. It shows that this company is a financially beast of a company. But if everything is solid, then why is the stock down? I mean, historically, the company has performed extremely well. There is no sign whatsoever that the company is not a financially good company. It's a financially excellent company. And there is no question in my mind that Adobe is a very strong company with a very impressive financial track record. The real question is where it goes from here. And I think that's where the risks come in. That's where the bear case comes in. And that's where the narrative that Adobe is a value trap comes in. Analysts, in fact, do expect revenue and earnings to grow at a slower pace than it has in the past. They expect earnings and net income to grow at 9 to 10% versus historical that, as we have seen, have been at least 12%, some years being 20%. So it shows that analysts are estimating that that growth is getting slower, and evidently from what we have seen, it has gotten slower over the last 2-3 years, which takes me to the bear case of Adobe. And I want to examine firstly two things in terms of the bear case. Firstly, the demand side, and then in the next slide I have the valuation side. Now let's talk through the demand side first. So the first structural risk is the AI disruption. So the bear case is that AI is eating software, just like IT hardware was disrupted by cloud in the 2000s. AI could disrupt SaaS companies. Anyone from startups to big tech like Google can build very competitive apps that quickly with AI can match and can challenge Adobe. So this undermines Adobe's moat. Its subscription model is no longer unique, and it has a risk of long-term structural decline in relevance. Now there is also a demand risk here, because as AI tools reduce the need for large seat counts across sales, marketing, creative, and HR departments, there could be signs that AI may consolidate seats, so it may reduce the workforce that uses Adobe products rather than expand them. And that growth slows or reverses, in fact, Adobe's core user base, because if they have fewer paid licenses because of the fewer workforce that is needed to produce those end results, then you have revenue pressure for Adobe. And the third risk is competitive risk, because you have new entrants and big tech entering this market. And Adobe is no doubt the biggest market shareholder, and many designers and creatives say that, Adobe is the status quo. But you have companies like Figma, Canva, Runway, which are rising with very strong funding and faster innovation, with big players as well in cloud players like Google, Microsoft, that are leveraging AI and compute scale to build free and cheap creative tools. Younger demographics may opt out of Adobe entirely. That is not to say that Adobe is not using AI, which we'll talk through in just a second, but it's just saying that there is more competition that is rising and could disrupt Adobe in some way. In case you guys don't know, the design market, the design tool market itself is growing at 6% CAGR growth, and Adobe is growing at a faster growth than the market itself. So with new competition coming in, we could see Adobe drop below that faster growth that it has seen, and as a result we could see Adobe lose market share, especially in the creative suite, and it could weaken its pricing power as more competitors come in with cheaper models for the younger generation. Now the bear case in terms of the valuation side is very simple, and it's one thing that is called stock options. Although with the current valuation, with the current expectation, the end of year PE ratio for Adobe is expected to be roughly 15.6. If we were to use the stock options and treat it as a real expense, EPS falls to almost 20. And many SaaS peers as well have very similar or even worse dilution. So that means that Adobe actually is more expensive than what the numbers suggest. And investors could punish valuation further. Now, if growth slows down to maybe close to 0%, PE could even compress to single digits, like hardware firms have seen, like Dell, during cloud disruption in the 2000s. So there could be a potential severe multiple compression. In fact, here I have some extra data on stock-based compensation so that you guys have an understanding on what I'm talking about. In an ideal world, this should be considered as an expense to the businesses, but many businesses try and hide this in their annual reports, try to hide it in footnotes, but essentially Adobe's expense or stock-based compensation expense has more than tripled over the last 6 years, from 610 million to 1.8 billion, and therefore it gives a perception of a lower PE ratio than what it should have been. It is not to say that Adobe is the only company that does it. There are other companies that do it, but it's something to know. It's something to be aware of. Now, there's also the bull case of Adobe, and this is a very, very strong bull case. There are three growth pillars that Adobe is currently focusing. The first one is groundbreaking innovation through AI products. Adobe launched their Acrobat AI assistant, their Firefly app, their Gen Studio, which are very high margin subscription-based revenue streams, and they're already on track to surpass 250 million in ARR this year, which shows that the AI monetization strategy is working. It strengthens Adobe's position as a leader and it supports high margin growth. So I do expect higher margins coming in. I do expect more growth through those applications, through those products, which takes us to the second pillar, which kind of works together with the first one, which is that Firefly and Adobe Express open doors to new consumer segments who previously found Adobe's tool too advanced or maybe too expensive. And AI simplifies those workflows. It lowers barriers to entry and it allows Adobe to enter a new consumer segment. So it actually expands Adobe's total addressable markets. It creates an on-ramp for millions new users, and it diversified revenue beyond professionals that use the traditional services like Photoshop, like Adobe Illustrator, that were a bit more complex. That essentially allows Adobe to challenge some new players like Canva, for example, which is very user-friendly, and it allows people that are not creatives as a status quo to use those platforms, to pay for those platforms to create an end product. Now, the third pillar is their supply chain. With Gen Studio and Firefly integrated within Adobe's analytics and marketing stack, it provides enterprises with an end-to-end content creation, management, and personalization platform. So it does solve for a critical enterprise pain point. It strengthens the enterprise stickiness and it creates a deep integration across Adobe's already very strong ecosystem, which does boost cross-sell and retention. So overall, Adobe is investing heavily into AI to provide new products and to strengthen their products and their supply chain of products to get more users, to increase their revenue and create a higher margin business. Before we dive into the rest of the video, I want to thank today's sponsor, Fiscal AI. If you're serious about investing, this platform is a game changer. It gives you beautiful, clear graphs with all the KPIs you care about in absolute numbers and percentage changes. It has powerful forecasting tools so that you can project performance and even calculate a company's intrinsic value. It has industry benchmarks so you know exactly how a business stacks up, and it has detailed equity research papers with everything you need. Above all that, it's all integrated with AI so you can leverage AI in every part of your analysis. This is honestly a no-brainer platform. I use it every single day, and for a limited time you can get 15% off using my link in the description and pinned comment below. Don't miss it, sign up now. Using my tailor-made financial model, I've estimated the real value, the intrinsic value of Adobe as it's currently trading at around $350. For revenue growth and EPS growth for the next 5 years, I have estimated 9%, which is roughly around what analysts expect. For free cash flow, I estimated 11% because Adobe has historically been really good at converting net income into free cash flow, and free cash flow has been growing more aggressively over the last few years. Now, I have used a 26 PE, which is the 3-year average, which is currently higher than the current PE ratio. And with a margin of safety of 50%, 8% discount rate, I have estimated with margin of safety that that the DCF intrinsic value of this company is $280, which is 21% below its current price. So it does show that with my margin of safety, this is yet to be an attractive company to invest in. Now, if we do the EPS method, the intrinsic value without the margin of safety is $445 a share, which is above the current price. So from an EPS standpoint, this is an attractive opportunity. In terms of what I am doing, I'm currently not yet buying Adobe. I'm still evaluating whether the opportunities outweigh the risks and whether the current price outweigh the risk that could compress Adobe even further. I think there is potential for Adobe to drop even further, for the PE ratio to drop even further, and so I'm still evaluating on whether I should enter Adobe and at what price point I should enter. Now, as you guys have voted from my poll, and thank you so much for engaging with me, on Friday I'll post a video on UNH. There have been a lot of updates this week that have costed a few points from the share, and I will go through one by one what is going on with UNH and what to look out for. Thank you again so much for being so engaging and for watching my videos, and I'll see you guys on the next one.